Assalamu alaikum. The day is 9th of January 2025. My name is Muhammad Hanzala. The topic today will be operating expense capitalization. So moving on to the first topic or subtopic. Actually, before we move on, I want to give credits to Aswath Damodaran, professor of finance at Stern School of Business at New York University. So the concept was basically popularized by this man over here uh, 10 years ago. So 10 years ago, he had the idea to come up with capitalization of R&D. His data source and everything is online on his page in NYU. And also, a lot of the topic is structured with the basis of the book here on the right, the little book of valuation, how to value a company, pick a stock, and profit. Also by Athwes Demodoran. Okay, moving on, slide number two. We have to differentiate what is operating expense and capital expense. Operating expenses are expenses that are supposed to create benefit for the current year. But capital expenses are expenses that create benefits over many years. So operating expense also could be called a short form is OPEX, and capital expense short form is CAPEX. So this is the differences. Now we look at why do we need to capitalize some operating expenses. First, what we have different industries, they have different operating expense that should be considered as capital expense. So if we look at tech and pharmaceutical companies or firms, they they have to expense their R&D as capital expense, not operating expense, because we expect R&D to produce commercial products in the future, benefiting for many years, not just the operation for that current year. Same goes with consumer product companies. This they spend a lot of money on brand name advertising. So this cannot just be considered as operating expense because this create long-term value, long-term investment, similar to capital expenditure in the cash flow statement. And also another example, this is all within the book. Another example is consulting firms. Their expense in training and recruiting personnel is also a long term investment. This is just the most significant capex by industry. But this is not capex that is stated in cash flow statement, but something we need to capitalize ourselves. Okay, what is the effects of not capitalizing certain operating expenses? So what happens or what tend to happen is you understate the true earnings of the company because operating expenses are in the income statement. This will lower the earnings of the company and also understate the invested capital because when we capitalize an expense, you not only transfer it to the cash flow statement, but you also transfer it to the balance sheet in terms of invested capital. For example, the research and development asset will be capital uh, spent in R&D, will be capitalized in the balance sheet, similar to how you have property, plant, and equipment in cash flow statement, which is your normal capex, also stated in the long-term assets in your balance sheet. So another thing is when we don't capitalize the certain OPEXs, the accountants, or I mean the management, will not be accountable for the investing of these items. It's mainly because they don't have any incentive from the shareholders to perform better on their spending on R&D, for example, if it's a tech and pharma company. And then we look, what is the solution? So first of all, we have to find how long it takes for your OPEX, for example, research and development, how long will it take for your expense to create a commercial product? So this depends on the industry. So today, we will look into the SaaS company, so software as a business, software as a software as a service businesses. So that's what SaaS stands for. So for SaaS businesses, it's a software business. So if you look at your left table, it'll be under computer, software, and service. It takes around 3 years. This is all estimation, depends on the company also. But usually, industries will share the amount of time it takes for certain OPEXs to create commercial products. As you can see, software comes with a more faster frequency in creating commercial products from their operating expense that we convert from R&D to capital expenses. But if we compare it to, let's say water utility or natural gas, it takes 10 years. So this also depends on the industry and the product the company makes. So what is the or amortization period? This is the period it takes for the company to benefit or make a commercial product from the operating expenses that we capitalize. So now moving on, this is my Excel sheet to basically to have a guide for the capitalization of research and development, but you can change it to anything. This is not specifically for research and development. You can capitalize other operating expenses. You just have to change the label from R&D expense to whatever. It could be SG&A even. So everything shaded in blue, the light blue, is something you should input. Everything else, so everything colored in orange, should not be touched because it's all formulated. So from the left, we see we need to input operating income, EBIT, and then get the effective tax rate, net income, invested capital. Invested capital here depends on your definition of invested capital. Later on, I will show you an example. But for me, invested capital is just the total equity and the debt minus cash. So some people do not minus cash, but this is again up to interpretation. For me, I do less the cash from the invested capital portion. And then we have capex. For capex, I know Aswath Damodaran likes to less or add acquisitions into the capital expenditure for tech companies, but I just do only for PPE expenditures. Again, also up to interpretation. D&A, meaning depreciation and amortization. This is also something you can find in the cash flow, and you should input that. Amortizable life, this changes, of course, based on the previous slide. For in this case, it will be 3. And if you have a more longer amortization life, the graph below it will be longer. So instead of 0, -1, -2, -3, it will be longer. What is zero? Year 0 is the current year. -1 means the year 1 year ago. -2 means the year 2 years ago, 2 years previous, and then so on. So we have the unamortized portion. So because it's 3 years, we have to spread it to 3 years. So every year we less 0.33333, right? Until it reaches 0 by the 3 years back. And then we get the unamortized portion. So what is the unamortized portion? This will be the assets that is going to be added in your balance sheet. And for the right side is the amortization year. This is just a third of your R&D expenses. So because it's divided into 3 years, we have to divide the expenses into 3 years. So this amortization for this year means that that's the amortization expense that will fall under the expense that will be added into the income. So it will be added to EBIT and net income, and would be less. Actually, will be added also to depreciation and amortization. So if you look at the right side, conventional versus capitalization or capitalized R&D. This is just the result page. So this is the effect. Also, you don't have to touch this because it will automatically fill. And we can see the before adjusted and after adjusted ROIC. So what are we looking for exactly when we do this? We want to see that ROIC increase as we capitalize R&D. If we capitalize and our ROIC is lesser, this means management fails into bringing more value from R&D. And we will see an example in the next slide, in the next coming slide. So effects of capitalization. So initially what we're doing is we're taking the expense from the income statement and we're moving it into the balance sheet and the cash flow statements. But we're also amortizing the R&D expenses. So initially, the adjusted EBIT will be EBIT plus the expense because we don't want to take out the R&D expense. Of course, if it's SG&A or other expenses, but in this example, it'll be R&D expense. Then we minus the amortization from that OPEX. So in this case, R&D, we minus the amortization. And then also adjusted net income, same thing, same concept, just net income plus R&D expenses minus R&D amortization. For adjusted invested capital, we have the normal invested capital and then we add the capital invested in R&D. This is the one I showed you earlier that would be added to the balance sheet. And now adjusted capex. I didn't mention this before, but capex also changes. Capex is just basically the R&D expense for the year, just the normal one, the one that you see in the income statement that we're capitalizing, but we move this the whole thing into capex. So capex will be also increased. And then we have adjusted depreciation and amortization. So again, like I mentioned earlier, it would just be the normal depreciation and amortization, but we add the amortization from research and development. Now we look at it in an example. So this example is from Qualys, a cybersecurity company, is also which is considered a SaaS business company. So in this case, all I did was I had to input in the blue shaded cells, and then the everything will compute for me. So in this case, I want you to focus on value of research asset. So we see the unamortized portion. This is the portion that's going to be allocated into invested capital. This is the added asset or research and development asset that's going to be added to the balance sheet. And then amortization for this year, that's the expense that's going to be accrued. Now, if we look below that, we see expenditure and amortization. So expenditure is just your normal R&D expense, your normal income expense. So we have to add this back to your EBIT. And amortization is just the amortized expense that we have to minus from EBIT. So the net effect will change EBIT. In this case, we have expenditure more than amortization. So if you look at the right side, EBIT increased from 163 to 188. And all these numbers are in thousands. So this would be 163 million. From an EBIT of 163 million, it moved to 189 million if you round it up. And then same thing with NOPAT. NOPAT is just with the tax rate. Net income, same thing. We just use net income as the base. Invested capital, as you can see, the invested capital increased more than 2 times, or actually a bit less than 2 times, almost 2 times. Why is this? Is because the value of asset is value of research asset. So this is based on R&D asset that we spent and we capitalized is 205 million. This is added to our previous invested capital of 232.9 million. So of course this will increase the invested capital quite significantly. And because of this increase in the denominator for ROIC, because the invested capital is increased, then our ROIC adjusted is actually less than the conventional method of calculating ROIC. In this case, our adjusted or capitalized R&D ROIC is less, which means management is not efficiently deploying investment in research and development specifically. Now we see capex increase substantially because now we're considering the whole portion of R&D is a capital expenditure and not a operating expense. And then D&A, or depreciation and amortization, also increased quite significantly, because this is not a is now considered non-cash because we're amortizing. And now we look at net capex. Net capex is just the capex minus depreciation. And then we have a calculated adjusted ROIC minus ROIC. So we get negative 22.88. Of course, this negative 22.88 is subjective to how much the ROIC of the company from the starting point, which I will get into in the next coming slides. So I will talk to you and I will share with you the SaaS industry analysis using R&D capitalized, or capitalization of R&D. So first, what we're looking for, we're suggesting that amortizable life for all these companies is 3 years. Of course, this is not always the case, depends from product to product, but keep it simple. And also, the amortization for each year is uniform, meaning that it's if it's 0.03, 0.3323, it will always be like that for the other 2 years. And then we have, you know, we took the companies from most of the companies of the SaaS that are classified as SaaS companies. We took it from SaaS Capital Index. You can search them. They have some public data on the SaaS companies, especially small companies. But this also, they share data on public SaaS companies. And then we want to see the profitable. If it's not profitable, then it doesn't work too well because EBIT will be negative, right? And then we all want we also want to see spending on research and development. From our or from my experience, DDOG, the ticker symbol DDOG, that is also a SaaS company, but it didn't spend on R&D. So of course we didn't include it because there's nothing to capitalize. Now moving to the overview. So the overview is that SaaS industry analysis. So we have this basically the x-axis is all the companies that that I managed to pick from the basically the Excel earlier, and that is meeting the criteria of the previous slide. And then we have the left is just the percentages, whether it be adjusted ROIC minus ROIC or adjusted ROIC. So adjusted ROIC is just the ROIC after capitalization. So the bar chart, yeah, so the bar chart is okay. There's a mistake with this chart. So basically, it's showing that the legend says that adjusted ROIC minus ROIC is the green bar, but it's also the red bar because this is a bar chart and shows the two different colors. If it's green, it's positive. If it's red, it's a negative number. And if it's the line chart is actually the adjusted ROIC as a whole number, right? So we see that some companies, although their ROIC is high, their adjusted ROIC is high, they actually decline their adjusted ROIC compared to their ROIC before capitalization. So we see Qualys, Adobe, Microsoft, Google, Oracle, CRM, SAP, Now, ServiceNow, and all these Intuit. Actually, yeah, Intuit. And then we have APPF. I forgot what actually the company's name is, but APPF, Workday, which is WDay, DT, and BL all have adjusted ROIC that is minus ROIC that's positive. That means their ROIC after capitalization is higher than before capitalization. But as you can see, Qualys, Microsoft, you know, P PayC, PAYC, and some other companies like Zoom, they have high adjusted ROIC. It's just that they don't have that increase after capitalization. So we see that management could either solve this by investing in more profitable or more basically more efficiently managing the R&D expenses so that it can yield a better earnings, because what we're looking for is earnings from our research and development. Or the other solution is to cut back on their expenses on research and development. That's the two solutions. Of course, that's just a broad answer. This, companies are very complicated, but that is everything for the SaaS business or industry analysis. We have the actual numbers with a table form. So this is the table form. As you can see, amongst the biggest adjusted ROIC is Zoom. We have Qualys. We have Google, and among the smallest is Palo Alto or PANW, which has an adjusted ROIC of negative 57%. I believe this is because they just got profitable. So when a company just gets profitable, they have a very low EBIT. So you have to look at that also. Actually, we could have actually excluded Palo Alto, but because it's actually quite a big company, I just added it. Okay, so thank you for listening. And this short video, hopefully, inshallah, will teach you something. How do I incorporate this into the analysis of companies? I don't necessarily transfer everything operating expense into uh, capital expenses, but when I want to see management's efficiency in producing more earnings from said operating expenses, it would be very useful to look into this as an analysis, separate analysis, quantitative analysis. And that's it for me. Thank you.